Hello, today is Monday, the 29th of December, 2008. This is Brian Shannon from alphatrends.net. The market's closed here, and we had a mixed session. It was a real low volume once again, heavier than the last 2 days, but we're still in this end of year, kind of holiday period where I think that we're going to see continued light volume. Maybe you get something to happen on the last day of trading there, which would be on Wednesday, in terms of bigger volume. But a lot of people are taking this week off, so you've got to be very quick to be in and out of your trades. You're going to be trading smaller share size and just generally, again, managing risk as always. The market remains in a bear, we remain in a bear market. That we're down to an important level here. The NASDAQ 100 is struggling with this level. That's it's generally been between this level right here, 2870 or so, and these intraday lows that it's seen down near about 2850. So you can see that we kind of broke below a little bit of support here earlier on today. Let's take a look at that on a 10-minute time frame. We had broken below this support here from last Thursday and Friday, and then continued lower, another lower low, and then late in the day we had some buying here. The market got back above its VWAP, and then right here at the close we got a little push higher that basically got us back into this zone here on the 30-minute time frame, where you can kind of look at it as really has to probably close below 2850 before we can consider this next prior level of support as something that would come into play. And right now it's just hard to imagine any real big moves materializing out of a low volume environment such as we're in. We do remain intermediate term negative as well, with these lower highs and lower lows, and of course this declining 5-day moving average. So any long side trades have to be really considered as just very short term scalps, because the path of least resistance on all but the 1 minute time frame here remains lower for this market. So I think that 2850, particularly on a closing basis, breaking back below that, we could see some give up, maybe even down towards that $27 level. If we look at the 60-minute time frame, remember it was last week that we had broken this trend line and seen the lower high. It was the two-thirds retracement that has really been a strong level of resistance, two-thirds retracement from the election high to the most recent significant low. That two-thirds retracement level is where the sellers have been, and that will continue to remain up near 31, an important level going forward. The market remains in a downtrend, but there's some great intraday opportunities. Oil was the big mover on the upside today, gaining 6%, and you can see here on the 10-minute time frame it got back above that 5-day moving average. We back it up to a 30-minute time frame. It's still we've got the 5-day moving average is declining. What we want to see now is maybe that level acts as support. This the oil market is just got some incredibly volatile moves in there. It's definitely not something that I like to trade. A lot of people look at it, and you can see here that this level is going to be important near 33. That has been prior support that did act as resistance and led to this most recent leg lower. So up near 33, which is still very a nice trade away from here, 2 points higher. I'm not going to be involved in it, but if you're looking at oil, I think you want to see basically 29 hold as support. Maybe you get a little pullback. That 5-day moving average acts as support. That would be nice to see. You are seeing some volume here on these moves, so a real nice volume move in here, followed by a low volume pullback. It is tradable if that's your your market to trade. It's not my market to trade. I will comment very briefly on gold, even though I say I won't comment on gold. I put some gold stocks up on the blog today, so I should make mention of that, I suppose. You can see here that it's up to this trend line that's seeing these lower highs throughout the year, so it'll be important to see it get above there. This is also the 200-day moving average, which you can see here, green moving average is declining. I would think that you probably don't want to chase gold here. It's just had a move from 70 almost to 87, so big percentage move. I think it would be healthy for gold if this thing is going to recover, is maybe even come down and build a right shoulder you could look at this as potential for a right shoulder in here. So maybe a pullback down towards 85, 80, I'm sorry, 82 or 83, and then a move higher. But I think it needs to consolidate. It's had a nice run, and now it needs to probably consolidate a little bit in here. The semiconductors were up 14 cents today. Still, obviously, a broken market in here. It's below that $17 level that had been important resistance. Let's look at the 30-minute time frame. These longer-term time frames, you've got to really change the scaling to really take a look at what's happening in here. But the 50-day moving average is declining. The 10 and 20 are moving lower as well. This market's trying to find some support in here at this level, which had been resistance over here. So I think 16.5 to 17. This 16.5 is going to be very similar to the level in the Qs that I had mentioned, which was down at about 28.50. So the important support on a closing base is going to be 16.50. If it can hold above that, we may save the next shoe to drop, basically, which could see the market retest those lows. So we're at a pretty important level. Getting back above 17, I think would be a good move for this market. Maybe that 5-day moving average flattens out and acts as support. We're still in a bear market. I'm only pointing out a potential scenario, but the path of least resistance remains lower. We've got this, this $17 level looming. That's the important level for resistance. 16.50 as far as support. We're going to have to break that range to really have any idea of a direction that might be able to sustain itself. The Russell 2000 had been holding along this trend line that we can see a little bit more clearly here in the 30-minute time frame. We saw that it broke down below that, but held above this $46 level. I think 46 is important, but again, we've got a declining 5-day moving average. We've got lower highs, more frequent tests of that support. Breaking below and holding below 46 on a closing basis, I think you can start to look at some of these next levels to be tested on the downside. And let's take a look now at the financials. The financials are holding up still at above that $11.40 or so level. Let's take a look in there at a 30-minute time frame. So think about $11.40. If it can close above that, that's the more important level, similar to 28.50 on the Qs. We might be sucking in more shorts here. So if we can get a reversal out of here, it could be a significant reversal. That's something you have to keep your mind, open to. Clearly, though, the path of least resistance is lower. Odds don't suggest it. Odds suggest further breakdown. But in this low volume environment, you have to remain very nimble. We've got a lot of cross currents. Obviously, all the headlines remain negative, and perhaps even more so than what we've seen with global conflicts and that sort of thing. But the only thing that pays is price. So if it can get back above 12, maybe we see a move up towards this little trend line, and then perhaps we can see it recover back up above the more important $13 level, which would also take out that 50-day moving average. It remains a time not to be making big directional bets, in particular because we've got this very light trading volume. So remain nimble. And of course we've got the year end coming up here with all kinds of little games maybe being played by some hedge funds moving forward, trying to mark their positions for a more favorable closing. But the S&P 500 is holding above its critical level of support here for the intermediate term, which is that $85 level. Breaking below and closing below there could pave the way for a test of the 82, and then who knows, maybe even we go back down towards these lows. But we remain in a very volatile environment, that's further exaggerated and harder to trade because of the lighter volume. So it's going to be perhaps above this level, 87.25 or so, that the buyers may come back into the SPY, and of course we've got these lows, but more 85 to 85.5. Breaking below there, then I think you've got a bigger reason for concern. But right now, low volume environment, you've just got to be very nimble.